Today on the BiggerPockets Ask BP podcast, we're going to be talking about how should one factor in appreciation when analyzing a real estate deal. Stay tuned.
You're listening to another BiggerPockets Ask BP podcast, where you'll hear short, direct answers to your biggest real estate questions. Submit your question today on Facebook, Twitter, or the BiggerPockets forums by using hashtag AskBP. And don't forget to pick up your copy of the Ultimate Beginner's Guide to Real Estate Investing and other great content when you sign up for your free account at BiggerPockets.com. With that, let's get to the show.
Hey, what is going on, everyone? My name is Brandon, and you are listening to the Ask BP podcast. Just want to say thank you for joining today. And I do want to ask you, if you have not yet left a rating or review in iTunes for the show, I would really, really appreciate it. I'm trying to get to 100, and I'm at like 60 or something like that right now. So if you could leave me a rating or review, that'd be awesome. And with that, let's get to the show. So today's question comes from Charles from New York City. And Charles asked, how should one factor in appreciation in a real estate investment? So first of all, let's talk about what appreciation is. I'm not talking about how I appreciate you listening, though I do appreciate you listening to the Ask BP podcast. We're talking about appreciation as in values rising. So appreciation is when you have a property and it's worth $100,000 today, and in 5 years it's worth $120,000. Appreciation caused that. Now, what causes appreciation? A number of things: supply and demand, scarcity, but also just inflation, prices going up over time. All those things kind of contribute to appreciation. There's also something called forced appreciation, which we're probably going to get into today, but that's the idea of forcing a property to climb in value by adding stuff. But again, we're not going to really go there. Appreciation is one of the 4 wealth generators of real estate. Basically, there's 4 things that makes rental properties especially very, very powerful. There's cash flow, there's appreciation, there's loan pay down, also called amortization, and there's tax benefits. Those 4 things make real estate really, really awesome. And technically, you get out a fifth on their leverage, but it's a little different. But again, cash flow, loan pay down, appreciation, and tax benefits. Appreciation is one of the most important of that list. Appreciation has made millions of people millionaires. Just ask anybody who owned a property in California for more than 20 years. I mean, appreciation has been very, very, very helpful to people who own houses in places like California or any big city where appreciation's been strong. And I mean, nationwide, appreciation's been pretty heavy over the past, 50, 100 years. I mean, it's moved along steadily, moving prices up, which is great. That said, how should we look at appreciation in an investment property? You've probably often heard me say that appreciation is the icing on the cake. In other words, appreciation is not the cake itself. Appreciation is something that's extra, that's bonus, that you should hope for. That'd be really great to have, but you should not plan your investment around. Now, I will say that this is a little bit, specific on who you're talking with. Some people bet heavily on appreciation. Look at house flippers. I mean, technically that's forced appreciation, so you could argue that they're not betting on appreciation, but in a way I think they are. What really people did for a long time, especially like 2004 through 2007, people bet on appreciation in order to make a bad deal a good one. And that's where there's danger. Let me say that again. People bet on appreciation to turn a bad deal to a good one. Let me give you an example. You buy a house in 2004, and the thing, it's going to cost you to hold on to the property. It's going to cost you $1,000 a month, but it only rents for $600 a month. You're losing $400 a month every month. Now, you and I are probably looking at that going, that's crazy. But thousands upon thousands of people did that very thing because they're like, but prices are going up so fast, who cares? Right? Like, we can lose $400 a month because next year it's going to be worth twice as much money because we saw some crazy inflation, or not even inflation, crazy appreciation that didn't match with inflation, that didn't match with much of anything else. It was just crazy appreciation. And so people would buy bad deals in order to hoping the appreciation would bail them out. And of course that worked fine until the music stopped and figured out, that there was somebody without a chair and whatever other musical chair analogy you want me to use. So that was a very real thing that happened. And it's kind of coming back. I feel like more and more people are talking about appreciation. Now, again, there's nothing wrong with appreciation. There's nothing wrong with it. There's nothing wrong with even like hoping for it or you running numbers and putting some numbers in for appreciation when you're doing your analysis. However, if you're buying a bad deal because of appreciation, I think you should think twice about that. You're doing nothing more than gambling at that point. I mean, you are gambling. You're saying, I am going to wager that this property is going to go up in value and then I'll get my money back and I'll do well. Again, that doesn't always work. So when you're analyzing a property, here's what I would suggest. Buy where appreciation is likely and possible. If you want to play the appreciation game, buy where it's likely and possible, but still invest for cash flow. So let me tell you an example of how I'm currently using appreciation in one of my investments. I just bought a rental property. It is in a really good town, the same town that I live in. I paid more for it than I normally pay for a property. Normally I pay like $40,000, $50,000 for a deal. I paid $70,000 for this one, and it's going to need $20,000, $25,000 worth of work. And then I'm going to have some I'm going to refinance it and hold on to it for a long time. And at the end of the day, I'm only clearing $50 a month on this property. $50 a month on this property. And if you guys know me, I've said it before, I like to have $100 per month minimum cash flow per property. And this one, I'm going to have not that. So the reason why I decided to do this is because I am playing a little bit of an appreciation game here. I bought a property that is in a really good location, a great school district. It's going to be super easy to manage. It is going to have the best possibility for climbing in value over time. And I see the rest of the market heating up, nationwide. I think this thing's going to be okay. Now, granted, keep in mind, I did not overpay in that I'm not going to get any cash flow. I'm going to get a little bit of cash flow. And in fact, that $50 a month, I'm actually going to be making about $150 because I'll be managing myself. But when I analyze a deal, I like to pretend that I'm not going to manage it. So that way I never count on that money. But so I'll be making a little bit of cash flow. And that's after everything. That's after repairs and planning for vacancy and capital expenditures and all those things. I'm going to clear about $50 a month at the end of the day. It's going to be a very easy property to manage. And remember I said I bought it for $70 and I put about $25 into it. Let's say I put $30 total, including refinance costs. I'll have a loan for $100,000. That property is worth between $130 and $140, maybe $150 today, because I bought a property that needed some work. So I forced some appreciation in a way. It's kind of like combining flipping, but that's a whole different topic, different conversation. So I have immediate equity in the property already, which makes me happy. Even if prices didn't shoot up through the roof, even appreciation didn't carry that property away, it's still worth, at minimum $30,000 more than I'm going to owe on it. And so I have that assurance as well. And then I'm going to hold on to it for a number of years. I might not hold on to it for 5 years, maybe 10 years, whatever. During that time, I'm going to be paying the loan off. Great. During that time, rents will hopefully go up. Rents usually go up over time with inflation. Rents will probably go up, but my mortgage, staying the same. So now I've got higher rents, the same mortgage. Hopefully then appreciation comes into play. I'm hoping that this property will climb in value faster than what a lot of other ones in the area maybe are doing, because I bought in a great town, great school district, great property, fixed it up nice. I've got the best chance for appreciation. So notice this, I bought the property with a little bit of cash flow, and I'm hoping appreciation comes. Nothing wrong with that. But I did not buy a bad property hoping the appreciation bails me out. And that is how I think you should incorporate appreciation into an investment analysis. And so if you're using something like the BiggerPockets property analysis calculator or like the rental property calculator, you can actually plug in numbers for appreciation and for your income going up and expenses going up. You can plug those numbers in if you want, but you don't have to. If you don't have that calculator, if you're not using that, if you're just using Excel, if you want to try to figure out a way to program in that future appreciation, you can if you want. But again, I wouldn't base your decision upon it. Hopefully that makes sense in kind of how I view appreciation. And one more thing I'll leave you with. As you grow in your investments and as you get more and more money, maybe you want to play more of that game. Because I'll be honest, millionaires are made from appreciation oftentimes. And if you can learn to read a market and read where it's going, that might be a game you want to play. A lot of experienced investors do play that game because they have the money to gamble. But at the beginning, I do not recommend gambling with that money unless you have it to gamble. It's the same thing. Don't go to a casino if you can't afford to lose that money. Don't buy a property based on appreciation if you can't afford to lose it. And you probably will. So with that, let's get out of here. Today's success quote comes from Thomas A. Edison. We all know Edison. He said, "Many of life's failures are people who did not realize how close they were to success when they gave up." So how close are you to success right now? If you're struggling to get started, how close are you really? Anything in your life, could even be real estate or not real estate related, but people often don't realize how close they are to success, and then they quit. And so, I guess take that with you today. Next time you want to quit, next time you feel like giving up, just remember you might be inches away from hitting gold. You never know. With that, let's get out of here. In pursuit of your dreams and your goals, don't just learn, but take action. For the Ask BP podcast, my name is Brandon. I will see you on the next podcast. Signing off.
You've just heard another episode of the BiggerPockets Ask BP podcast. Submit your question today on Facebook, Twitter, or the BiggerPockets forum by using hashtag AskBP. And for more incredible real estate investing tools and education, including a free download of our book, The Ultimate Beginner's Guide to Real Estate Investing, head over to BiggerPockets.com and sign up for your free account today. We'll see you on the next show.